So how much can you really trust the holdings in your index fund these days? We got some interesting changes that have happened to a couple of the major indexes out there involving some familiar company names that may leave you scratching your head just a little bit once we get into that. Plus, we'll also share with you some disturbing statistics involving financial decisions that occurred during the course of COVID. Of course, COVID's still very much still with us, so some of those financial decisions may still be ongoing, and we want to give you some strategies to maybe offset some of those things that you may have gotten forced into as a result of the economic difficulties involving COVID. So welcome to the program. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. You're listening, of course, to Dollars and Cents, coming to you live here on Sunday morning on a host of radio stations throughout the Central Florida region. Our team of certified financial fiduciaries at Nelson Financial Planning stands ready this week to help you change your life with a successful and cost-effective financial plan. First and foremost, my thanks goes out to two of those fellow certified financial fiduciaries at Nelson Financial Planning. Garrett Fields, Kristen Cayley were the hosts of the program last week. If you missed that, then you missed an interesting discussion about some of the things that might cause the IRS to take a closer look at your tax return, among a host of topics that they covered. So we want to take a moment and thank them for their good efforts on getting out some solid information to our listening audience during a week where I was away. So thanks to them for that. And of course, if you missed any part of the show last week or want to check out exactly what those IRS red flags might be, then of course you can catch the program on any of our podcast channels. Pretty much every one you can imagine we are on. We've got our Nelson Financial Planning channel on those platforms. So if you have trouble finding us just by simply searching Nelson Financial Planning or Dollars and Cents with Joel Garris, then go to our website, Nelson Financial Planning, and there you will find upper right-hand corner a bunch of icons. Click on the one that looks most familiar and you'll get directed directly to our channel on that particular platform. So as we like to do, first segment, the week that was, if you will, and then we've got a quick follow-up on one of the things I was talking about at the end of the program a couple of weeks ago. But of course, the week that was, the markets were basically flat. Which you would not have thought after the first 3 or 4 days of the week. But Friday, there was a bit of a recovery in the markets. At the end of the day, I think the Dow wound up for the week down 50 points. So in essence, a flat year. In terms of the economic data, starting to see some interesting things. We've been talking about on this program, this battle, if you will, this boxing match between inflation and interest rates, sort of opposite corners of the ring. Well, we had some interesting data that has been coming out, particularly looking at things like gas prices, right? Maybe some improvement on that over the course of the past 30 days. Certainly, if you look at the national averages on June the 14th, so just about a month ago, average price of a gallon of gas was slightly over $5. Today, nationally, it's about $4.58. Matter of fact, I was driving around yesterday in town here and saw it for $4.09. So certainly a change in that, mostly related to the fact that oil down from a high of about $130 a barrel, hitting about $91 a barrel on Thursday. Went back up, I think, to $96, $97 on Friday, but certainly some easing of that pressure. And the question really is, if you think about it economically, is some of that pressure getting eased because of sort of the world economy and the events of the world economy? Or is it maybe getting ease because we as humans have a tendency to change our behavior when it benefits us? And certainly perhaps driving a little bit more efficiently, or maybe not driving quite as much, or stringing all those errands together on the same day. Maybe that's a way to reduce down demand. In other news, lumber costs. If you're looking to go to Home Depot to finish up a project this afternoon, you should see that the price of lumber down quite a bit from where it was just 60 days ago. Lumber costs, it just in May, have gone from $1,670. That's a crazy increase that happened with lumber costs, to now down almost $1,000 off of that high in May to around $683. Looking further afield, as I mentioned, I was away. I was traveling internationally. One of the interesting things when you travel internationally these days is that dollar's pretty strong. And that really allows you to shop in Europe at a much cheaper price tag than what you have previously done. In fact, it's almost like when you go and you buy something, it's like a 20% off coupon that you're holding in your hand when you have those greenbacks. So some interesting things that are happening across the board, and that's really driving, right, this battle that we've been talking about on the program between inflation and interest rates. Just to recap what that matchup is, right? As inflation goes up, one of the things that the Federal Reserve is taxed to do is to fight inflation, and they do that by raising interest rates. Hence, the Federal Reserve has been very aggressive over the course of the past 3 or 4 months here at raising rates to try and increase those interest rates as a way to reduce down inflation. Widely expected here as we get into the back half of this month of July that they're going to raise rates another 0.75%. That'll be a 1.5%, because last time they did it raise of 0.75% as well. So pretty dramatic in terms of the increases of interest rates to fight off inflation. Now, the other thing that may be working, this may be, I guess, a little bit of a silver lining, maybe working in favor of making the Fed's job a little bit easier as we hear these numbers, right? These gas numbers we were talking about earlier, the lumber numbers that we were talking about earlier. As we hear and sort of take a look at those numbers, that the fact that those numbers have dropped down helps to reduce down the inflation. Obviously, those numbers haven't sort of run their way through the economy, but at the end of the day, that could be some silver lining on the ultimately that battle between inflation and interest rates. As we like to say on the programs, continue to stay tuned, because we're certainly in the early rounds, maybe mid rounds, of that heavyweight battle between interest rates and inflation. But maybe a little bit of a silver lining in that some of these prices have come down that helps to placate inflation as we look ahead. Haven't seen that quite in the numbers, certainly not in the inflation numbers that are coming out this past week, but maybe a little bit of a silver lining that may allow the Fed to not have to be quite so dramatic on those interest rate increases. As we said, stay tuned. We'll continue to talk about it here on the program in the weeks and months ahead. With that, we'll go to a break. This is Dollars and Cents with Joel Garris of Nelson Financial Planning. Despite current appearances, right? We're seeing a few more people wearing masks these days, particularly as the current COVID numbers go up. There's, of course, though, no testing, right, to get back into the United States. So that makes it a little bit easier to travel internationally. But COVID is very much still out there, and its impact and its lasting impact has just been tremendous, right? I mean, you're talking about over 1 million lives lost here in this country alone. And as the cases rise here, certainly one of the biggest impacts is on the financial side of folks. Kiplinger recently published the following numbers that we wanted to share with you this morning. Nearly 6 out of 10 people withdrew money from their retirement during the past 2 years as a result of the COVID pandemic. 63% of them used that money to just simply cover day-to-day expenses. 41% of that number used it to cover medical expenses. So now what? What do you do beyond the health and the mental aspects of COVID, the real financial aspects? If you're one of those 6 in 10 people who had to raid a retirement account as a result of COVID, how do you recover from that? What are some of the strategies that you can do to try and address that? So that's what we're going to be talking about in this segment of the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So those are the stats, right? 6 out of 10, according to Kiplinger, wound up raiding their retirement over the course of the past 2 years just to meet day-to-day expenses. And as you might well imagine, that creates a host of issues, right? First of all, it means that if you had to take money out of your retirement, it means that there is less in there now to actually use, right? And to grow and to compound going forward. Also, when you take money out of a retirement account, you got to pay taxes on it. Now, in 2020, you had a one-time special deal where you could spread those taxes out over 3 years, but that only applied to distributions that you took in the year 2020. And of course, if you're taking the distribution out and you're not old enough, then the 10% penalty applies. Not old enough being 59 and a half. The reality is, again, 2020, that penalty was waived, but it's not waived now. That is for sure. So you can see where if you're taking money out of your retirement account on an unexpected basis, then you can certainly see that the impact starts to really cascade throughout a host of different things involving your finances. So how do you recover from that? Like, how do you really start to say, okay, how do I best position myself so that I don't have to fall in this particular trap again? And it starts, of course, with building an emergency savings account, right? The statistics on that are just as drab, if you will, on the amount of people that actually do have a savings account, an emergency savings account. Only like 23% of the population has enough cash on hand to meet 6 months of expenses, and another quarter don't actually have any. So obviously having an emergency savings account allows you to better handle emergencies so that you're not having to raid your retirement account when emergencies comes up. So number one, it starts with building that emergency savings account and making sure that you're in good shape on that. And to try and recover your retirement, the reality is that you should certainly want to see if your employer has a match. The reality is that a lot of employers, although less so now, but certainly there's still a number of them out there that do offer matches for making retirement contributions. There's also some tax credits that are available if you make retirement contributions. So those are some great ways to be able to kind of recoup that lost money, taking advantage of that employer match and also taking advantage of some retirement contribution tax credits that still exist today and have for a number of years that allow you to get a tax credit simply by making a retirement contribution. Remember, a tax credit is very powerful. That reduces down your tax bill dollar for dollar. So those are quite valuable options to look at taking advantage of to try and recover from withdrawals out of your retirement account. And as we always say to people, it's important to start small, right? Don't try and put all of the money that you took out at a single shot, right? It's so much more important to put a little bit in at a time to try and recoup. Also a great way to invest just in general, right? Because if you're putting money in on a regular basis, then you really do help to smooth out the volatility of the markets. The reality is you can't necessarily make up for the lost time, but maybe if you start by adding something small, do it consistently over time, and that's a great way to kind of recoup or put a band-aid on what it is that you had to do in order to sort of get through these COVID times. Lastly, we would say take a look at your debt, right? It's so important. One of the great ways to sort of get through those unexpected times is not having a lot of excess debt or debt at high interest rates that's going to really compound and increase at a dramatic level. So another strategy would be to look at paying off that debt to try and get that in as good a shape as possible. Another great way to sort of prepare for a potential emergency. Another issue that we see an awful lot is beyond the financial impact of COVID. There was certainly a sort of a lost time factor. What we're talking about there is the millions of folks that had plans, right? Maybe you had travel plans, you had cruising plans, time with grandkids, community involvement, whatever the case may be, you had plans. And the reality is that those plans got very much disrupted as a result of COVID, right? Not able to travel, not able to go, not able to do, certainly not able to get out as easily in the community as what you might otherwise have. And certainly that's something that we see all the time from folks that at the end of the day, beyond the financial, the emotional impact, more importantly, you kind of lost time. And that's particularly important if you're at that stage in life where you're like, well, how many more years do I have of good health that I can continue to go and do and all those kinds of things. And now COVID has sort of shortened that window much more dramatically. So what are some of the things that you can do from just sort of a time management perspective? And we thought this piece was kind of interesting because time management experts typically talk about 3 different things you can do to sort of try and make up for lost time. And it starts with making a list. Now that's oftentimes a lot of what any good analysis starts with is that you've got to make a list and that really helps to kind of set those priorities. Next, you sort of try and accelerate the timing. How do you create more time? Well, you look at what you're doing now, the commitments that you have, and you ask the question, well, do I really still need to be doing this? If I'm doing something just because I've always done it, it doesn't mean that you really should continue. And then lastly, sort of play the clock, right? Try and do these activities in the most time efficient manner possible in order to be able to take advantage of the activities that you want to do. Try and maybe time them together so you're able to do multiple things all in one trip perhaps. So anyway, those are some of the techniques to sort of make up for that time loss piece that came with COVID as well. With that, we're going to take a break and return after these messages on Dollars and Cents with Joel Garris of Nelson Financial Planning. Wanted to spend this segment of the program following up on an item that we mentioned briefly at the end of the show from a couple of weeks ago, and it had to deal with title fraud and some of the paid services that are available to monitor the title of your real estate to prevent fraud. And in fact, a number of ads were run during the course of this program here on the various radio stations throughout Central Florida that we're on. And so when we first heard the ads a few months ago, it really kind of caused us to scratch our heads as to, well, first of all, what's going on there? Number two, can that really happen? And of course, anything can really happen, because if you're engaging in fraud, if a criminal is engaging in fraud, then yeah, they can sign a bunch of documents and sign your name and file them and get their buddy to notarize them and all that kind of stuff. The reality is that it can certainly happen. And so what the service or the advertisement was talking about is, you can, subscribe to this service for a monthly fee, and they will monitor your title to make sure that there's nothing getting changed on it that you don't realize. And so we actually had an extensive conversation with our attorneys on this, and to talk a little bit about that. And they said, well, yes, it can happen, because it's fraud, and fraud can happen, but the greatest and easiest way to prevent it is that most of the local counties have a service that allows you to just go online and get the exact same thing for free. Both Orange County, Volusia County, all the local counties certainly have it. So we want to just take a moment and really sort of re-emphasize that to folks, because we think that's worth doing. At the end of the day, to go to the website, and all you have to do is put your name and your email in. I mean, it doesn't ask for even the property address. It doesn't ask for your date of birth. It doesn't ask for your blood type, like so many other things these days, it seems. But in this particular case, it was very easy to do. And we just want to take a moment and sort of reiterate that and why that's important, because it is in fact a free service that is sponsored by a lot of local counties. How do you sign up for it? Well, you go to propertyfraudalert.com, or you can go to your local county property appraiser's website, and there you will see where you can get directed to what ultimately will be this propertyfraudalert.com website, and then put your name in and put your email in. It does ask you to put your name in twice, email in twice. It takes like 15 seconds. And then all of a sudden, then you wind up getting notification. Because at the end of the day, any of these paid services are just monitoring services. They're not designed that they can prevent fraud, because fraud is impossible to prevent. And so what these services are is that they allow you to ultimately monitor just like they would. So we want to encourage folks to do that. We think that that was sort of an interesting thing that we learned that is a valuable service that folks can take advantage of. And at the end of the day, it doesn't cost you anything, doesn't require you to sign up for anything different than what you already can easily do with your name and email address. So just want to kind of recap on that. In other news, just want to take a moment to add to sort of the current crypto meltdown. And yes, I think the better word is meltdown. It's not crypto winter, as you hear some folks talking about it. Winter assumes that there's some seasonality to crypto, and there isn't. A lot of folks said crypto was going to be a great inflation hedge, and yeah, the biggest decline in crypto has happened while inflation has been going up at its fastest pace. So it's a meltdown is really the better way to say that. But our point in this is that beyond just what is happening with the crypto meltdown, along to sort of make matters worse, along comes the IRS. According to a recent statement by the IRS believes that it's missing out on over $50 billion of potential tax revenue as a result of crypto trading and crypto transactions. $50 billion is what their claim is that they are missing out on in terms of crypto and crypto transactions. So the IRS is estimating the tax gap. Now remember what the tax gap is. It's the difference between what it collects and what it should be collecting. It estimates that tax gap has to do with over $50 billion when it comes to crypto transactions. And so I understand that, yes, okay, part of the crypto technology relies on blockchain technology, which basically means that the counterparties to any transaction are anonymous. Well, the counterparties to any transaction is always going to be a buyer and a seller, and those people are sort of unknown to each other, but because of the blockchain technology, there's a record, if you will, of that transaction. Well, it's fine if it's anonymous on the blockchain. In the IRS's minds, they don't really care. And in fact, starting 2 years ago, the number one question that you are asked to answer on your tax return, once you put your name in, once you put your address in, once you put your social security number in, the number one question that then gets asked is, have you sold, received, exchanged, or otherwise disposed of any financial interest in any virtual currency? I don't know about you, but I don't know how you write the question more broadly than that. So it is intended to specifically pick up anybody who is utilizing any virtual currency of any kind. And so it really is looking at that activity. So even though it may be viewed as anonymous on the old blockchain, in the eyes of the IRS, it is certainly not. So from a tax perspective, what you need to make sure that you are doing is to make sure that you are not treating it as an anonymous transaction, that you are officially reporting that on your tax return. Generally, those types of transactions would need to go on Schedule D, which deals with capital gains and losses. Obviously, if you've got a gain, then there's different tax treatment on that, depending upon whether that was a gain that you held for 12 months. That would be a long-term capital gain. If it's less than 12 months, it's a short-term capital gain, and that is treated as being taxed as ordinary income. So understand that when you're reporting them, there's different ways to also take a look at how those numbers play out in terms of what they look like from a tax perspective. So some important things to be thinking about, particularly if you're looking at the crypto side of things. But ignore it. As we've always said on the program, we've never really been sort of believers in this notion of a technology. Well, let me rephrase that. Certainly the technological impacts behind crypto, I think, are going to have some widespread implications for the future. The actual currency, virtual currency itself, we don't think that there's really a whole lot to be talking about from an investing perspective. And certainly the volatility of late would sort of underscore that concept. With that, we're going to wrap it on up and get on out of here. We thank you for listening to the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. So, how much can you trust the holdings of your index funds these days? And particularly when you think about owning particularly index funds that track certain segments of the market. See, every 6 months or so, whatever the holdings are of the indexes, they get reevaluated, and certain companies will come out of those indexes and other companies will go into the calculation of what that index number represents. And that's a process that happens, as we said, on a regular basis, just about every 6 months. Well, here at the end of June, we saw once again that same kind of turnover among different companies and different company names and different indexes. But what was interesting is some of the names that were getting swapped around really were pretty surprising, particularly if you're following a dividend orientation or more of a value orientation, or at least trying to reduce down exposure to more of those growthy tech types of companies that certainly were all the rage for the past few years, but of late they have not been doing particularly well. Well, some of the changes in the indexes are certainly going to surprise you. So in this segment of the program, we're going to talk about what those changes are, and then some of the things that you can do to make sure that you don't get caught up in those types of changes. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of radio stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us either on our YouTube channel at Nelson Financial Planning or on whatever it is your favorite podcast platform is. We've got channels on it, so make sure you search us out. Can't find us all that easily? We'll go to our website, Nelson Financial Planning. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get immediately connected over to our channel on that particular platform. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So what are we talking about here in terms of indexes and how they sort of have changed here mid-year? That's a normal part of the process, but some of the names and some of the movements I think are going to surprise you. Certainly when I read about them and did some additional investigation, it kind of surprised me about some of the names that changed in particular. And we're really talking about the difference in particular two broad indexes, and it's the Russell 1000 Growth Index and the Russell 1000 Value Index. And those are often thought of as the indexes that best represent sort of that growth approach to investing and that value approach to investing, right? So, of course, among large companies, it's 1,000 in each of them. There's 1,000 different companies. So, generally viewed as sort of that broadest market index that looks at those different types of companies. And of course, remember, a growth company is generally going to be a company that is growing at an accelerated level, right? I mean, most companies should be growing, but the definition of a growth company is that it is growing at an accelerated level relative to normal growth rates for that particular industry or the economy as a whole. So when you think about growth companies, you think about companies like Tesla, right? I mean, they, kind of been growing a tremendous amount from zero to where it is now. That's a good example, if you will, of a growth type of company. Similarly, flip side, value companies may not be growing at an accelerated rate anymore because chances are they're more established, more traditional types of businesses. And in that case, they just pay dividends on a regular basis. Now, if you're an investor, there's a certain appeal to dividends, particularly these days, because dividends represent income, reliable and consistent income that a company is paying out each and every quarter that goes directly to you as income. So that's the big difference. And obviously now, as you might well imagine, people are looking for income in all kinds of places. Certainly dividend paying companies helps to generate that. So that would, by the necessity, put you more on the value side of things. So that's the backdrop of which we are talking about. Now, so you got the Russell 1000 Value, we got the Russell 1000 Growth, right? You got the difference between the two. Now, here comes the changes. We'll step back a little bit. Remember the FANGs? We've talked about them before on the program, but the FANGs, Facebook, Amazon, Netflix, Google, those companies, those handful of companies that were driving a tremendous amount of the performance of the markets over the past 5 years, viewed as traditional growth companies. Two in particular of those FANGs, if you will, Facebook, Netflix, down over 50% since the beginning of the year. So what was driving the market previously, obviously driving the market the other way now, particularly if we focus on Facebook and Netflix, both of which widely considered growth companies. All right, I mean that they were part of the FANGs. I mean that's like the growth index that they were part of and considered as that. Now, however, because those companies have declined as much as they have, lo and behold, on June 30th, those companies were eliminated from the growth index and moved over to the value index. I kid you not. This is how this thing happens. The process of determining the holdings inside of an index is simply a formulistic approach. looks at the companies, looks at the price, looks at the earnings, and then makes a calculation as to which index that particular company should be in. The problem with that, as an investor, is you should now be scratching your head. If you are a value investor and looking for dividends, and now all of a sudden, what was the high-flying, high-growth bangs are now in your value index, well, how accurate of a reflection is that of the companies that you really kind of want to own if you're a value investor? Similarly, if you're a growth investor and you own the growth index and you still think that Facebook and Netflix, those are still very much growth companies, well, wait a minute, now they're not part of what I own. Why would I want to not own them now? If I liked owning them and I still think they're good companies, why now I don't own them anymore in my growth index? You see the kind of the confusion, and I guess the bottom line here is it always goes back to some of the things that we say here on this program on a regular basis. Make sure you know what you own. A lot of people think that by owning indexes, then I'm covered, I'm good, I got nothing to worry about. Here's a great example of, wait a minute, maybe you're not covered the way that you think you are covered, or maybe you don't have the types of companies that you think that you are having, because the index itself, particularly when it reconfigures itself every 6 months, is making those decisions based upon a formulistic approach that has no basis in what that company is or is doing or what that company is all about. Lots of folks rely on index in investing, and if you're a do-it-yourselfer, fantastic, okay? But understand that it always comes back to understanding and knowing what it is that you actually own, rather than relying on formulas that determine what you're going to own. So make sure you know what you own and why. If you're a value investor, you want dividend-paying companies, fantastic. That's what you should be owning. If you're a growth investor, great. Own those companies that are growing at accelerated rates or are expected to over the future. Our advice, by the way, is always to own a little bit of both, maybe bending a little bit more to the dividend side of things, because growth has certainly had its heyday for the past several years. And as we know, that stuff what was leading the market in the past doesn't necessarily lead the market in the future. So make sure, bottom line, as an investor, you know what you own and what's inside the investments that you own, so you have a good handle on the types of companies that you actually own. With that, we'll take a break and return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning.